What's going on, everyone? Ty here. I just wanted to say hello. Happy Monday. For starters, I do want to say I am not a registered broker or advisor. All the information that I'm sharing with you now is just solely based on the opinions of myself that I've gotten through just personal research. What I want to start doing is bringing a trade of the day. Today's trade is going to be Marriott International. They're actually one of the largest hotels in the world. Their biggest purchase was, I think it was in 2016 when they purchased Starwood. So Marriott is very large. They have 8,000 properties across 132 countries. So that presence is there. Long term, I love it. It's one of my favorite companies. Anytime you travel, you see a Marriott. You see, of course, you see Hilton and whatnot, but Marriott, you're going to see it everywhere because of that large presence. It's one of those things where it's a win-win because business travel is always going to be there. My experience in Marriott, I see business travel coming in and out. You have conference spaces, you have restaurants. So it's definitely one of my favorite companies in regards to travel related and having an investment. There are a number of ways where you can add this to your portfolio. You can simply buy a stock if you're bullish on it. But let's also keep in mind the times that we're in now. We have interest rates. Now, interest rates on a rise. Of course, that's less money in the economy, less disposable income. So that's less travel from a leisure standpoint. But of course, it's not going to affect your business travel, hopefully. And also, too, that business travel isn't even at pre-COVID levels. That's projected to get back to pre-COVID levels about 2024, 2025. But of course, that's subject to change. But there are a number of ways and a number of factors to take into consideration when you're adding this to your portfolio, right? Like I said, you can simply buy a stock if you're bullish and you believe that that stock price is going to increase. But also through options. There are a number of ways that you can add this to your portfolio for short term because those options contracts are going to expire. You can simply buy a call and you buying a call, you're just hoping that that price increases. Of course, you have your options chain. You can pick which day you want to go out to. As you can see, you can go as far as 809 days out. I'm just going to go to the 46-day expiration here, DTE. And right now, the stock price is trading at 161.02. And you'll see that red dot right here. Don't worry about the brown because you will have to worry about the brown if you're trading options because this is volatility. Right now, that IV rank is at 47. So premium is a little high. Now, anything expensive, you definitely want to try to sell it instead of buying it. But that's up to you. If you want to buy a contract or if you want to sell a contract. Preferably, when IV is high because prices are higher, I like to sell it because it's more expensive. But like I said, whatever you feel is best for you and your strategy, there are a number of ways that you can add this to your portfolio. If you want to simply buy a call, you can simply buy a call. You're hoping that price is going to increase. You can pick your strike price. Obviously, if you go below the stock price, the current stock price, you're going to buy an in the money option. Of course, it's going to be a little bit more expensive. But if you want to take a little bit more risk, save a little money, you can go above the stock price at 165 and you see increments of $5 in regards to the strike prices. There's another way that you can cap this here. If you were to add a leg and you want to this is a defined strategy. So instead of buying a call, you now have a call spread where you're defining your strategy. So you are capping your profits, but you're also capping your losses. So, it's a win-win. It comes, you reduce your risks. So of course you reduce your profits. Now, if you don't want to take this route, paying a debit, you can sell. You can simply sell a put. Now that put is still going to put you in a position where you want the stock price to increase. This is a little different here because your profits are capped now because what you're doing is you're collecting a premium of $440. So you see 440 right here, of course, because that contract is 100 shares. So this is another way that you can be bullish. This is also another way where you can increase your chances of profiting because as time goes on, you're collecting that data every day as opposed to if you buy a contract, you're losing that data, that premium every day. Now, if you want to reduce your risk, if you want to reduce the amount of buying power that this is going to take up, you can add an extra leg here in a sense where now you have a put spread. So of course, you'll see the difference in between the buying power effectiveness. You still have the same position, you still have the same bias, and you're protected here. If you're unsure and you want to set a range, you're like, hey, I don't know if it's going to go up or down, but I believe it's going to be within this range. You can also buy and sell, you can sell, it's going to be called a strangle. You're going to be profitable as long as that stock price stays between 140 and 190 within the next 46 days. Now, of course, again, if you want to reduce your risk, if you want to reduce that buying power reduction, go ahead and just add a few legs on the other end. You now have an iron condor. So there are a number of ways that you can add this to your portfolio. There are a number of ways that you can be bullish. I can show you a way if you want to be bearish. If you're like, hey, the next 46 days or whatever time frame that you choose, hey, it's actually not going to increase, it's going to decrease, right? What you can simply do is you can sell a call. Sell a call, you want that stock price to continue to go down. If you want to reduce that risk, if you want to reduce that buying power reduction, go ahead and add that other leg in regards to buying. So you're buying and selling a contract simultaneously. Reduce that buying power, reduce your risk, still bias of you being bearish. You can sell a call. You can also buy a put, right? Buy it at the higher price. And I'm just clicking on random strike prices here. Don't look at the strike price and say, oh, this is where you need to get in. This is just me setting you up for strategy to carry out on your bias. All right. Now, if you don't want to go into this naked position, and naked position is just one contract, go ahead and add that leg, that second leg, buying and selling a contract simultaneously, a defined risk trade, and it's called a spread. So this here is a put spread. You're going to pay that debit. So that's a way to be bearish. So I just showed you a number of ways where you can add this to your portfolio by simply buying stock, shorting the stock, or going long. Let me know what questions you have. What do you think about Marriott? What is your favorite brand when it comes time to travel?